Government insurance. Government programs that deal with risk are often analogized to insurance, or may even be officially called insurance, without in fact being insurance. For example, the National Flood Insurance Program in the United States insures homes in places too risky for a real insurance company and charges premiums far below what would be necessary to cover the costs, so that taxpayers cover the remainder. In addition, the Federal Emergency Management Agency, FEMA, helps victims of floods, hurricanes, and other natural disasters to recover and rebuild. Far from being confined to helping people struck by unpredictable disasters, FEMA also helps affluent resort communities built in areas known in advance to face high levels of danger. As a former mayor of one such community, Emerald Isle, North Carolina, put it, Emerald Isle basically uses FEMA as an insurance policy. Shielded by heavily subsidized financial protection, many vulnerable coastal communities have been built along the North Carolina shore. As the Washington Post reported, in the past 2 decades, beach towns have undergone an unprecedented building boom, transforming sleepy fishing villages into modern resorts. Land values have doubled and tripled, with oceanfront lots selling for $1 million or more. Quaint shore cottages have been replaced by hulking rentals with 10 bedrooms, game rooms, elevators, whirlpool bathtubs, and pools. All this has been made possible by the availability of government money to replace all this vulnerable and expensive real estate, built on a shore often struck by hurricanes. After one such hurricane, FEMA bought an estimated $15 million worth of sand to replace sand washed away from the beach in the storm, according to the Washington Post. Unlike real insurance, such programs as FEMA and the National Flood Insurance Program do not reduce the overall risks. Often, people rebuild homes and businesses in the well-known paths of hurricanes and floods, often to the applause of the media for their courage. But the financial risks created are not paid by those who create them, as with insurance, but are instead paid by the taxpayers. What this means is that the government makes it less expensive for people to live in risky places, and more costly to society as a whole, when people distribute themselves in more risky patterns than they would do if they had to bear the costs themselves, either in higher insurance premiums or in financial losses and anxieties. Television reporter John Stossell's experience was typical. In 1980, I built a beach house, a wonderful one, 4 bedrooms, every room with a view of the Atlantic Ocean. It was an absurd place to build. It was on the edge of the ocean. All that stood between my house and ruin was 100 feet of sand. My father told me, "Don't do it. It's too risky. No one should build so close to an ocean." But I built anyway. Why? As my eager-for-the-business architect said, why not? If the ocean destroys your house, the government will pay for a new one. 4 years later, the ocean surged in and ruined the first floor of Mr. Stossell's house, and the government replaced it. Then a decade after that, the ocean came in again, and this time it wiped out the whole house. The government then paid for the entire house and its contents. John Stossell described the premiums he paid for coverage under the National Flood Insurance Program as dirt cheap, while the same coverage from a private insurance company would undoubtedly have been prohibitively expensive. But this is not a program for low-income people. It covers mansions in Malibu and vacation homes owned by wealthy families in Hyannis and Kennebunkport. The National Flood Insurance Program is, in fact, the largest property insurer in the country. More than 25,000 properties have received flood insurance payments from the federal government on more than 4 different occasions each. One property in Houston was flooded 16 times, requiring more than $800,000 worth of repairs, several times the value of the property itself. It was one of more than 4,500 properties whose insurance payments exceeded the value of the property during the period from 1978 to 2006. There is an almost irresistible political inclination to provide disaster relief to people struck by earthquakes, wildfires, tornadoes, and other natural disasters, as well as providing money to rebuild. The tragic pictures on television override any consideration of what the situation was when they decided to live where disaster victims did. The cost of rebuilding New Orleans after Hurricane Katrina struck has been estimated to be enough to pay every New Orleans family of four $800,000, which they could use to relocate to some safer place if they wished. But no such offer is likely to be made, either in New Orleans or in other places subject to predictable and recurrent natural disasters, ranging from wildfires to hurricanes. Even when there is no current natural disaster, just the prospect of such a disaster often evokes calls for government subsidies, as in a New York Times editorial. With premiums rising relentlessly and insurers cutting hundreds of thousands of homeowner policies from the Gulf of Mexico up the East Coast to Florida and Long Island, there is a real danger that millions might soon be unable to purchase insurance. That's a compelling argument for government help. Such arguments proceed as if the only real issue is covering the cost of damage, rather than reducing the risk of damage in the first place by not locating in dangerous places. Private insurance provides incentives to relocate by charging higher premiums for dangerous locations. But government-imposed price controls on insurance companies have had predictable results. As the same editorial noted, private insurers have jacked up premiums as much as they can and, when barred from raising prices, dropped coverage of riskier homes. Disaster relief from the government differs from private payments from insurance companies in another way. Competition among insurance companies involves not only price, but service. When floods, hurricanes, or other disasters strike an area, Insurance Company A cannot afford to be slower than Insurance Company B in getting money to their policyholders. Imagine a policyholder whose home has been destroyed by a flood or hurricane and who is still waiting for his insurance agent to show up, while his neighbor's insurance agent arrives on the scene within hours to advance a few $1,000s immediately, so that the family can afford to go find shelter somewhere. Not only will the customer of the tardy insurance company be likely to change companies afterward, so will people all across the country if word gets out as to who provides prompt service and who drags their feet. For the tardy insurance company, that can translate into losing billions of dollars worth of business nationwide. The lengths to which some insurance companies go to avoid being later than competing insurance companies was indicated by a New York Times story. Prepared for the worst, some insurers had cars equipped with global positioning systems to help navigate neighborhoods with downed street signs and missing landmarks, and many claims adjusters carried computer-produced maps identifying the precise location of every customer. After the catastrophic Hurricane Katrina struck New Orleans in 2005, the difference between private and governmental responses was reported in the Wall Street Journal. The private sector planning began before Katrina hit. Home Depot's War Room had transferred high-demand items, generators, flashlights, batteries, and lumber, to distribution areas surrounding the strike area. Phone companies readied mobile cell towers and sent in generators and fuel. Insurers flew in special teams and set up hotlines to process claims. The same difference in response time was observed in the recovery after Katrina. In August 2005, Hurricane Katrina flattened two bridges, one for cars, one for trains, that spanned the 2 miles of water separating this city of 8,000 from the town of Pass Christian. 16 months later, the automobile bridge remains little more than pilings. The railroad bridge is busy with trains. The difference? The still wrecked bridge is owned by the U.S. government. The other is owned by railroad giant CSX Corp. Of Jacksonville, Florida. Within weeks of Katrina's landfall, CSX dispatched construction crews to fix the freight line. 6 months later, the bridge reopened. Even a partial reopening of the road bridge, part of U.S. Highway 90, is at least 5 months away. The kind of market competition which forces faster responses in the private sector is, of course, lacking in government emergency programs, which have no competitors. They may be analogized to insurance, but do not have the same incentives or results. Political incentives can even delay getting aid to victims of natural disasters. When there were thousands of deaths in the wake of a huge cyclone that struck India in 1999, it was reported in that country's press that the government was unwilling to call on international agencies for help, for fear that this would be seen as admitting the inadequacies of India's own government. The net result was that many villages remained without either aid or information 2 weeks after the disaster.